I want to begin by asking some questions, and since my friend David Barsamian is recording this, I will say what I see. And so by a show of hands here, how many people think that local businesses are pretty key to the prosperity of your community? Okay, everyone has raised their hands, and let it be said we are here in the great independent Boulder Bookstore, which is a model of a reason why we embrace local businesses. So the second question I want to ask is, how many of you do your banking at a local bank or a credit union? Now again, almost all the hands went up. There are a few exceptions. We'll take them out and have a chat with them later. The final question is, those of you with pension funds, how many have your pension funds largely invested in local business? Now, I duly report that not a single hand went up in the air. And this is perverse. It's perverse because half of our economy, half of the Boulder economy, half of the Colorado economy, half of the US economy is local small business. And yet, we Americans, when it comes to long-term investments, stocks, bonds, mutual funds, pension funds, insurance funds, we are 100% invested in either government bonds or Fortune 500 companies. There is not a whit of local investment in the $30 trillion that we have invested long-term. This is a huge capital market failure. And what I would argue is that all of us, especially those of us who are gathered in this audience who embrace local economies, we are systematically over-investing in Fortune 500 companies and under-investing, or that is totally neglecting, local small business. I think the reasons why this is happening are interesting and can be fixed, but let me just make one initial observation, that if capital markets were working, there would be a $15 trillion shift from Wall Street to Main Street. What would $15 trillion look like? Well, what $15 trillion looks like is $50,000 for every American man, woman, and child. For a 5,000 person town, $50,000 of extra investment would be $250 million more for that town to play with. For Boulder County, with 300,000 people, it would mean $15 billion more of capital for businesses like Boulder Bookstore, where we are tonight. I would suggest that with $15 billion more, the Boulder economy would prosper and grow dramatically. As Michael Brownlee, in introducing me, pointed out, we just did a study of local food here and saw that a 25% shift to food localization could be done for $100 million. A tiny fraction of that $15 billion could really make a huge difference in localizing food and creating almost 2,000 new jobs in this economy, or basically fixing about 1/7 of the unemployment problem here. And besides just the economic effects, let it also be said that local food contributes quite a bit to dealing with obesity and in type 2 diabetes. It is good for bringing down the carbon footprint. Because you bring more taxes into the government, it's good for the fiscal health. So there's many, many valuable things that happen with food localization. But I want to focus more broadly on the importance of localizing the economy holistically. If a $15 trillion shift happened from Wall Street to Main Street, it would be the most dramatic shift of money in US history. I mean, and think of what happens when the first $1 trillion moves out of the stock market. When $1 trillion moves out of the stock market, the prices of stocks drop because there's less demand. And that means that many people who were on the edge of leaving the stock market will leave. And more people will put more money into the local economy. So this is a transition that could actually move very quickly. What I want to do tonight is share with you 10 optimistic trends that I identify in the book, Local Dollars, Local Sense. It's worth saying that the first time that I spoke on local economy issues was at the University of Kentucky 15 years ago, and 2 people showed up, 1 left early. So I feel like the movement has come a long way since then. And I will run through each of these trends and provide a little bit of elaboration, and then we'll have some time for questions around each of these trends afterwards. So the first trend I want to flag is that there is a massive decline in Wall Street's credibility. This is great news because Americans have, for the last 25 years, automatically fed their retirement monies into Wall Street. There are 7,500 mutual funds in the United States, and not a single one puts money in local small business. We have artificially propped up the value, the power, and the influence of large global companies. I must say it has been very heartening over the past year as I've been finishing this book to see the growth of the Occupy Wall Street movement. And now even Newt Gingrich and Rick Perry attack Mitt Romney for vulture capitalism. And I think many Republicans really are concerned about this. So across the political spectrum, there is deep skepticism on Wall Street. And there should be, because the performance of Wall Street has been abysmal. I begin the book by performing an exercise with data from a Yale professor, Robert Shiller, who wrote a book called Irrational Exuberance. And on his website, he has historical prices of stocks going back to the founding of the stock markets 140 years ago. And what you find is that even though you have all of these investment advisors out there like Rick Edelman on AM radio telling you, put your money in stocks long term, you'll get 8%, 10%, 12%, 20%. In point of fact, all of these claims are made in inflated dollars. When you take inflation out, account for dividends, and don't automatically reinvest each year to just see what the annual rate of return is and how it would compare with other annual rates of return, the stock market has performed on average at 2.6% for 140 years. Now, if you're clever at moving your money in and out of the stock market at the right times, you can pick that up. So I assume that the goal to beat, that for local investment to beat, is not 2.6%, but a more robust 5%. And we'll come back to that number in a moment. If you were a perfect investor today, you maybe would put $4,000 or $5,000 a year of your hard-earned money into retirement. I talk about an idealized guy named Sam the Saver, who from the age of 21 to 65 is this perfect saver, puts $5,000 away. It gets augmented on Wall Street at 5% per year. And on his 65th birthday, Sam has about $750,000 in the bank, $750,000. What does that get Sam? After you take taxes out of his IRA payment each year, Sam gets an income of about $20,000 a year, which means that the most perfect saver is actually just above the poverty line. Now, of course, Sam is also going to get Social Security, if Social Security is still around when Sam retires. We'll come back to that in a second. But is this the retirement system that we intended, where a perfect saver winds up just above the poverty line? Now, are Americans perfect savers? Has the average American squirreled away $750,000 on their 65th birthday? Over the last few years, the average savings of Americans in this system has not been $750,000, it has been $75,000, which means that the average American is retiring with enough money in their IRA to buy groceries. That's it. We have set up Americans for a massive shock of guaranteed poverty in their retirement. And there's lots of factors that could make this a lot worse than I'm saying. For example, if taxes go up, all this tax deferral you've been doing will be worthless. Social Security could go bust. A lot of how you do in the stock market depends on when you retire. In 4 of the last 10 years, the stock market has collapsed. So timing is quite important here. And there's no reason why the stock market couldn't underperform its historic rates. In fact, that's probably what is going to happen if people move their money from Wall Street to Main Street. So my point here is that Americans across the political spectrum, whether they are anti-Wall Streeters or they are Tea Partiers, are feeling extremely insecure right now. And that is a basis for embracing an alternative. That's the positive trend. Second trend is the rise of Main Street's credibility in becoming a place to park your money. I talk in my book about a lot of recent studies that show that local small businesses are really the only places where we are getting significant job growth in our economy. We have data that show that when you invest or put money, let's just talk about purchasing. When you purchase $100 of books from a local bookstore, like Boulder Books, as opposed to $100 at Barnes & Noble, you basically generate 2 to 4 times the economic impacts in terms of income, wealth, jobs, taxes, charitable contributions. A Harvard study was published in the Harvard Business Review 2 summers ago showing that regional economic growth was positively correlated around the country with the presence of small and home-based businesses. And another study from Penn State has shown that per capita income growth is also primarily in those communities with high levels of small and home-based businesses. The data is overwhelming, and we know these businesses are extremely competitive. In fact, despite economic development's best efforts to kill local business, I'll say more about that in a second, local small businesses have a growing share of jobs in the economy. We know that the profit rates of sole proprietorships, where most small businesses are or start, are 3 times the profits of C corporations, which Wall Street businesses are. And when you look at foreseeable trends like rising oil prices that are going to make long-distance manufacturing by, say, Walmart in China a really bad business model, you can see ways that manufacturing and other kinds of activities that have gone offshore are going to come back to the United States. So there is going to be a local business renaissance in the years ahead. And yet, despite this, economic development agencies around the country continue to prioritize attraction and retention policies. And what's weird about attraction and retention policies is that you cannot attract or retain a local business. You cannot attract a local business because that's an oxymoron. And if the only way you retain a business is by paying it a bribe, how local, how rooted is that business? So the fact that most economic development is focused on attraction and retention is a clue that it has nothing to do with nurturing local small businesses. And in point of fact, I just finished a study for the Kellogg Foundation where I looked at the 3 largest economic development programs in 15 US states. And what we found was that something like 50+% of the programs, I'm sorry, I got that number wrong, that 80% of the programs were spending most of their money on attraction and retention, and something like 1/3 of the programs were spending more than 90% of their money. So it's a huge skew of dollars away from local small businesses. And that's what I mean, that economic development agencies have not paid very good attention to local businesses, and it's why local investment is all the more important. Because if we can figure out how we can put our money into these businesses, there are huge profits that you can make both personally and as a community. Let me now talk about the third trend. The third trend is that we are in the midst of a crowdfunding revolution. Let me talk about why it is that we do not have local investment right now to speak of. The problem is not the profitability, the efficiency, the performance of local businesses. I've made that clear already. The problem is that we have securities laws that were enacted in the early Jurassic period. And these laws basically have made it impossibly expensive for the 99% of us who are so-called unaccredited investors, that is, not wealthy people, to put our money into the 99% of the firms that are small. Instead, securities law says that if I'm going to take $1 from an unaccredited investor, I'm going to have to give you a thick disclosure document filled with all caps, 8-point font type that no human being has ever been observed to read. And that's supposed to inoculate you against me selling you swampland in Florida. It's an insane system. And one of the ways we can grasp how insane it is to look at the ways in which we do not care about Americans riskily putting their money into things that have nothing to do with local businesses. There are 1,000 casinos in North America. And if I walk through a casino door, do they say to me, "Excuse me, Mr. Shuman, but are you an accredited gambler?" No, they never ask that question. All may come in irrespective of your income. And before I sit down at the blackjack table, do they say, "We think you should be aware of all the risks of playing blackjack before you actually are dealt your first hand"? No. So we have two systems of risk in this country. One system, called gambling, is where everyone can lose everything irrespective of income, and chances are good you will. The other system, called local investment, where we say, sorry, but if you put any money in a local business without paying off a lawyer $50,000 to $100,000 for the disclosure statement, you'll go to jail. This is insane. It's an insane system of law. And the good news is that there's finally recognition across the political perspective out there that this needs to change. One of the great things that happened at the end of the 2011 Do-Nothing Congress is that Tea Party Republicans and Occupy Wall Street Democrats agreed to fundamentally overhaul securities laws by a vote of 410 to 17. they agreed to create a $10,000 exemption for individuals to put money into any business with no legal paperwork. Now, there are three bills that are following in the Senate. The securities regulator industry, which is the one industry that may lose their jobs as a result of this bill, they're fighting back. But I think that one of these bills is likely to pass. Maybe it won't be $10,000, maybe it'll be $1,000 that we let people put into local small business. Whatever it is going to be a home run. Because once we put a hole in this dam called securities law, the flow out of Wall Street is going to be so rapid, it's going to take the whole dam with it. And there are a bunch of innovations out there that even with securities law, they're happening. I mean, you can go online right now if you're not willing to get any return from your investment, and you can put your money in Indiegogo or Kickstarter, which are sponsorship sites. And by sponsorship, if you put in $10, you get a t-shirt. If you put in $1,000, maybe the new beer they're making, they'll name after you. But since you're not getting a rate of return, it's not regarded as a security. Or you could put your money in the global south, like Muhammad Yunus in kiva.org. Because you're not getting interest payments, you just get your principal paid back. In most states, this is not regarded as a security. But even if reform doesn't happen out of Congress, the revolution is still going to happen. And that brings me to trend number 4, which we are seeing the emergence of new techniques for people to issue local stock that are a lot cheaper than they have been. We've forgotten that even within existing securities laws, people in a given state, for a local business, can issue small stock. You know, you have to be a resident of that state to buy the stock. And you can do so, if you are clever, in a very inexpensive way. I'll give you an example. In Mount Ayr, Iowa, 15 years ago, there was a guy who wanted to set up in this very small town a grocery store. He needed $650,000 to do it. He created a small stock offering. He got 322 residents in the community to become shareholders of his business. This business has been profitable ever since. It has paid its shareholders an annual dividend for 15 years of 5.25%. And of course, these shareholders, are they going to go shopping at the Walmart? No way. They are the most loyal customers imaginable. Now, there are really interesting ways that people are bringing down the costs of doing the legal work. 25 years ago, when I was graduated from Stanford Law School, a outfit in Berkeley had just taken off called Nolo Press. And Nolo Press created do-it-yourself wills and trusts and estate documents, and basically put many of those lawyers out of business. We're now seeing ways we can do this with securities law. So I now work for a company called Cutting Edge Capital. My colleague, Jenny Casson, who does direct public offerings around the country, for example, she did one for a funky restaurant in New York called Workers Diner, and raised capital in small amounts from employees and from the customers and from the neighbors. But she's designing fill-in-the-blank templates for states around the country that will mean that you could do a direct public offering not for the $50,000 or $100,000 that a blue-chip law firm will charge you, but soon you'll be able to do it for a couple of $1,000s, maybe even less. And this will make it a revolution where we see many more companies, many more local businesses offering their shares to interested local investors. Trend number 5 is that we better understand the loopholes that can facilitate local investing. And I spend a lot of time in my book talking about clever techniques that people have used to basically say, well, this is not really a security within the definition of what the SEC is talking about. For example, people have taken over their banks and used their banks as local investment instruments. So how do they do that? Well, back in the 1980s and early 90s, the E.F. Schumacher Society worked with a local bank and said, tell you what, let's create a new kind of CD, certificate of deposit. We'll bring you investors to buy the certificate of deposit, and we'll tell you, the businesses, we want that money invested in. We will bring you those companies. And here's the deal, bank. You lose money, you take the CDs. You make money, you keep the money. And either way, you get administrative fees. Well, no bank would say no to this deal. It was a great deal. And E.F. Schumacher Society was able to support several dozen small businesses with about $3,000 loans each. It was a very successful program. And other banks paid attention to this. So the Alternatives Credit Union in Ithaca has a specialized CD right now that helps nonprofits. So, for example, if you're a housing nonprofit, you can get your members to put money into CDs in alternatives that provide money to help low-income people put their down payments on their first house, or maybe even their first apartment if they are homeless. And then the bank actually matches that CD with bank capital. And this has been a very successful program. Alternatives Credit Union is one of the larger and more successful credit unions in the country. Another model of this is in Boston, where Equal Exchange, the fair trade company, worked with their local bank, started as Wainwright, now it's called Eastern. They created a special CD just to support Equal Exchange. So $1 million now is lent to Equal Exchange through the Eastern Bank because of the CD that they went to the bank to help create. So that was one clever technique. Here's another technique. In many states, not all states, but in many states, co-ops are largely exempt from securities laws. So when you put money in your co-op, you're an investor. When you lend money to your co-op for, say, a capital expansion, say a grocery store like Willie Street wants to build a second co-op, you can put money into that second co-op and it's not regarded as a security. And we have many examples that I talk about in the book of co-ops that are paying 5, 6, 7% per year to their members for lending this capital. There's a co-op in Western Massachusetts called Co-op Power, where they have 390 members, 7,000 supporters, but the 390 members have each put in $1,000, and they use that money to in turn invest in all kinds of local energy businesses so that affordable, state-of-the-art energy efficiency, renewable energy, biodiesel kinds of products are available to the members. So in a way, this co-op basically became an investment fund. Another technique, pre-sale. Awaken Cafe in Oakland needed to raise about $80,000 for a new store. They couldn't afford to do the securities filings. So what they decided to do is they sold $1,200 worth of advanced coffee for $1,000 to people who are loyal customers. And these advanced purchases are not regarded as securities. And in this way, they have been able to raise their capital for the new store. Trend number 6. There are powerful examples of small town initiatives that are happening that are very inspiring. I tell the story of Fairfield, Iowa, where a guy named Bert Chernowski for the last 25 years has basically been recruiting, to be sure, mostly accredited investors, but recruiting them to support great small businesses in Fairfield. Fairfield is a town of 10,000 people, and yet Chernowski estimates that he has brought about $300 million of new investment into these local small businesses through just intensive recruitment, incubation, and sponsorships. And he's been so successful that actually there was a front page story about Fairfield in the New York Times called, the story of Silicorn Valley. Another success story is Hardwick, Vermont. Hardwick, Vermont is a 3,000-person community in Vermont, agriculture community. The farmers there got together to support their move into organics, value-added products like cheeses and casseroles, salad greens and very large CSAs, new restaurants like Claire's Diner. They created a food business incubator. In doing this work, a reporter from the New York Times noted that at a time when most towns, rural towns in America, were shedding jobs, this 3,000-person community created 100 new jobs around local food. And one of the tools that they used is they were very creative in developing new investment tools that facilitated farmers and residents to invest in one another's businesses. Another example from Port Townsend, Washington, another town of about 10,000 people. One of the peculiarities of securities law is that even if you're an accredited investor, you cannot be approached by an entrepreneur unless that person has a relationship with you, a pre-existing relationship. So a guy named James Frazier, who is an investment advisor in Port Townsend, said, I am going to go gangbusters and create pre-existing relationships. So he created something called LION, the Local Investment Opportunities Network. And he holds a big party every month where he brings together investors and business people, and they keep track of who now has the relationships so they can start circulating business plans to the appropriate people. And since 2008, they have moved in this 10,000-person town $2 million of new investment into local business. Exciting trend number 7. There are interesting ways that people are creating pools of money that invest in multiple businesses. And pools of money are important because it doesn't make sense for any of us to put all of our money, or even a lot of money, into one small business. You want a diversified portfolio, and a pool of money can give you some of that diversification. The problem is, going back to securities laws, is that we make it extremely difficult for unaccredited investors to put money into any pools of money. But there are some exceptions to the law that people have found and begun to exploit. For example, there are some revolving loan funds in New Hampshire, North Carolina, and Ohio that have exploited one loophole in the Investment Company Act and make it possible for unaccredited investors to put money into their revolving loan funds, which in turn are supporting local businesses. Another nifty loophole is that you can create your own local investment club. And right here in Boulder County, in the last couple of weeks, a new investment club linked with the organization's Slow Money has been founded. It's the third investment club nationally that Slow Money has put together. In my book, I write about the investment club in Maine called No Small Potatoes. About 2 dozen people, each have put in about $5,000, and they're investing in great, promising local small businesses. And most of those people are unaccredited, and one of the ways they were able to do that is they went to the securities regulators in Maine and said, look, we want to help some struggling businesses here. Will you give us an exception? And they said, fine. Number 8, we are in the midst of a new era of local stock exchanges. Now, it's not enough if we have a bunch of communities that have created a bunch of local stocks, because local stocks that you can't buy or sell leave many of us feeling stuck and prisoners of our investment. So we want to create markets. We want to create liquidity. The good news is that there's a history of local stock markets that traded local stocks. It just happens to be about 125 years old. And we used to have local stock markets all across the United States. And there's evidence that these stock markets actually boosted economic performance by facilitating more investment, equity investment, in promising local businesses. But then when the securities laws were passed during the Great Depression, a lot of these local stock exchanges no longer saw a reason for staying in business. National exchanges got more powerful. And today, there has been so much consolidation that basically we have 2 national exchanges, really they're global exchanges, the NASDAQ and the New York Stock Exchange, and 2 boutique exchanges in Chicago, which also only trade global securities. So we have no local stock exchanges anymore. But mark my words, they are coming back. A company in New York, Mission Markets, has a platform and basic permissions from the SEC so that if you come to them with, say, $50,000 to $100,000, they will create a local portal for exchanging local stocks in your community or your region or your state. And they have just entered a deal with the state of Hawaii to create a local stock exchange there. So this may well be the first local stock exchange we see. The state legislature in Hawaii last year passed a bill demanding one in the name of economic development. And I think by the end of 2012, it will be happening and begin to operate. Now, it may seem expensive to you to start a stock exchange for $50,000 to $100,000. So we have some entrepreneurs out there that are doing cheaper alternatives. An example is the Lancaster Stock Exchange, the LANX in Pennsylvania. We have the Uniex Stock Exchange that Michael Shumans has put out there, which would basically be a website that connects people to companies that have done public offerings and connects people to broker-dealers who can do the transactions. So there's a lot of playing around here that we're going to see. But the good news is that once we have local stock markets, you will start to see local investment portfolios. And you will start to see local mutual funds. And you will start to see local pension funds. And that's what's going to facilitate this $15 trillion shift. Exciting trend number 9 is that people are realizing that you don't have to wait to do these options. If you want to do these options with tax-deferred IRA money, you can do so right now. And you can do so through a technique called the self-directed IRA. Self-directed IRA means you go out, you hire a trustee who you tell where you want your money invested. And unlike a mutual fund, you could tell your IRA trustee, you could say, I want that money put in my local grocery store. I want to put in my local co-op. I want to put in a local property redevelopment project or a brownfields project. You can put that IRA money in anything except your own house. You can't invest in your own house. But interestingly, you can invest in your neighbor's house. And your neighbor could invest in your house. And you can start putting together transactions where we really can invest in our neighborhoods and take advantage both of the tax deferral of your IRA and the interest deduction that you pay on your mortgage each year. So there are people who are exploring that possibility right now. Exciting trend number 10. People are starting to realize that even if you never get that far, you should not be putting your money into Wall Street at all. Most of us should be putting our money just in ourselves. And this was a rather hard chapter for me because as I understood the implications of this chapter, I realized for many of the readers, what they just read about was kind of obsolete. Because frankly, I mean, let's talk about if your goal again is to do the 5% per year. And I do some of this math in the book and say, actually, if you add the benefits of tax deferral, you really should be trying to get with your local investment in untax deferred money a 7% per year return. Now, what can you do that gets you a 7% or better return? Well, the first thing you can do is avoid the use of credit cards. That's a home run that's often, gets you 10, 20% over that 7% rate of return. So really the first thing we should be doing is putting our money into bank accounts. Low interest bank accounts and just having that money there so you never have to pay interest on credit card debt. The next thing, putting your money into your house. Even if your house has no appreciation over its lifetime, it's a smarter investment than the 7% you might get on Wall Street. Why? Part of it is the funky tax laws that we have. Because with that house, you're deducting your interest payments on the mortgage each year. And at the end of owning your house for its lifetime, you can have up to $250,000 of gain with no tax. At the end of your IRA, you got to pay tax on everything. So it's a no-brainer to put money into your house. And again, I point out, this is with no appreciation whatsoever. What if you have more money? What if you're already, you're paying your mortgage each month? Should you then put money in your IRA? No. You should pay down your mortgage faster. Because that also is going to get you a higher rate of return than 7%. But why stop there? One of the things I talk about in the book is that even if you're putting your money into things that you'll never get your money out of, like say you put your money in energy efficiency and you're never going to get that equipment back in an increased value in your house. Maybe you will, but let's assume you don't. So it's a wasting asset. If you work out the math, in order to beat Wall Street, you would need like a 16% rate of return each year for 10 years. Can you do it? Damn straight you can do it. Put $1,000 in energy efficiency. Can you get $160 a year in savings? You betcha. Put $1,000 into a greenhouse. Can you get $160 in savings and not buying more outside fruits and vegetables? Of course you can. Put $1,000 into a great espresso machine. Can you avoid $3 a week at Starbucks? Yeah. What about $1,000 in your own education? Can you improve your income $160 a year? Of course you can. As even Warren Buffett says, investing in yourself is the best thing you can do with your investment money. The advantage of investing in yourself is that you control the investment. You determine whether these investments succeed. You are your own star of your own hedge fund. I would say that we have spent the world searching for high rates of return, and really we come back and see that all of the value is in our own backyards. And it's for that reason that I end the book by talking about a story, a children's story by Francois Dumont called A Blue So Blue that really moved me when I read it to a small child. And it's about a boy who loves a shade of blue, and he can't find it. He dreams about the shade of blue, but he can't find it anywhere in his world. And he travels everywhere to find the shade of blue. He goes to the ocean, he goes to the tropics, he goes to a blues bar in Louisiana. In a desert, he encounters a mystical chief who says, what you are searching for may have never been very far away. The boy then realizes where the blue came from. It was right at home in his mother's eyes. Thank you very much. And we have time for maybe 8-10 minutes of questions. And because we're being recorded on radio, I'm going to repeat your question. So don't make it too long. But whoever wants to say anything, please pipe up.
You mentioned that there's a possibility that Social Security will go broke. Some people think that that crisis is being manufactured and there's an effort to privatize it and put it into the stock market. To the extent that there are problems, they can be fixed. What are your thoughts on that?
So the question is the fear that Social Security may go bust fabricated by those who want to privatize Social Security? And I think the answer is generally yes. I believe that the Social Security fund can be shored up just by getting rid of the ceiling on income right now and basically having everyone pay in for every dollar that they receive in income. There's no, in my mind, no rational reason or fairness reason to cap it. And yeah, we can shore it up. But the point is that you don't control that decision. And there are a bunch of drunken pirates in charge of Congress right now who may well destroy this system in ways you can barely imagine despite your best arguments to the contrary. And that's why we have to start investing locally to create something we believe in and trust. Who else? Sir.
So large aggregations like pension funds, how do you get them to make investments locally?
Question is, how do you get large aggregators like pension funds to invest locally? Pension funds have an additional layer of law in it called ERISA, and this law says that you as a fiduciary have certain responsibilities about how you invest your money. And some fiduciaries have wrongly taken the position that only if you're a Fortune 500 company is your performance good enough to warrant our putting money into it. So we have to put pressure on those fiduciaries to say, you know what the word fiduciary means? You represent my interests. And if I tell you that my interest is investing in my community, you better start protecting my interests. Otherwise, you are in violation of your duty and and in violation of the law. Practically speaking, pension funds are going to be the last thing we change. The first thing we need in communities around the country is a critical mass of local stocks. Then we need local stock exchanges. Then we're going to see local investment funds. Then we're going to see some local mutual funds. And finally, we'll get through that fiduciary argument without any problem. But I do think it will be the last domino to fall.
What are your thoughts on local complementary currencies, like alternative, like the Ithaca dollar and things like that in terms of being a viable?
So the question is, what is my view about complementary currencies like the Ithaca Hours or the Berkshires? And what I would say is these are great experiments. We should encourage them. Some of them are going to succeed beyond our wildest expectations. But at the end of the day, local currencies, at least in the United States, are largely about encouraging people to buy things locally. They're not about investing locally. Now, Susan Witt, who's one of the architects of Berkshire's, has a vision of moving into local investment over time. And I think, one should watch for that. But I think just even if it does nothing but encourage people to buy local currencies is a great thing. And there are many other tools out there that accomplish this: local gift cards, local debit cards, business-to-business purchasing platforms, buy local campaigns, campaigns that get government to selectively procure from local businesses. All of these approaches, I think, are valuable in helping the local businesses that we invest in succeed and thrive. There's a question there?
That bill that just went through the House that they voted on, that was $10,000 per year, correct, for a small investor who's not accredited?
It's 10,000. So the question is around clarifying what the bill was. Actually, why don't you finish the question?
I'm just wondering if that's, can you invest $10,000 per company per year, or is that just $10,000 flat per year and that's it? And if that's true, then maybe writing your senator and saying, hey, this should be increased to, I mean, it already went through the House, but, increasing that, 10,000 just doesn't seem reasonable to me. I mean, that doesn't seem much enough.
Right. So to clarify what's in the bill says that you can invest $10,000 per company per year. Per company. So you can invest in multiple companies and thereby invest more. And I have to say, this is an area where I think reasonable people can come to different conclusions. Now, I have to say, 2-3 years ago, I was writing a bunch of articles that suggested that we create a $100 exemption per person, per company, per year. And part of the purpose of doing this was just to tease the securities regulators and to say, you're going to say no to this, but try to explain why you say no, why you think a $100 investment in a company is any riskier than my having a new $100 dinner at a restaurant down the street. And, I think that argument gained some currency, and people who were more ambitious added some zeros to the number. I must say, personally, I'm a little more nervous about any company taking $10,000 from any person. I feel for the average American, $1,000 may be the sweet spot. I could be convinced to $10,000. And this is part of the debate that's going on in the Senate right now. I mean, there are debates over other fine print items of these bills. But again, even if it's $100, it'll be such a dent in the armor of the securities regulators and expose the stupidity of what they do that I think it will be the beginning of the end of them. Back there.
So you highlighted 10 trends that are happening in the environment that we're operating in. Do you have any thoughts about what communities can do in the meantime and intentionally to take advantage of those trends? Are there mechanisms or entities and Boulder County, you're starting to get to know Boulder County well enough. Any thoughts about what might be appropriate for our situation here?
Right. So the question was, where can you get started with these 10 trends, especially here in Boulder County? And I would say that the home run is the self-directed IRA. I think getting a lot more people to move some of their retirement funds into a self-directed IRA, maybe 1%, and to use that money to put into Michael Brownlee's emerging fund for local food businesses would be a terrific start. And it's an educational moment. But there are other things that are going on here that are important. Lots of interesting co-ops in Boulder County where people might put their money. There are interesting credit unions that you could share some of these models with and work with them. There are small businesses that might be persuaded to do small public offerings to ramp up. I could see a local stock market here with some innovation. And remember, a lot of these innovations don't just depend on federal law, they depend on what you can get out of your regulators in the state. And I would suggest that you've got a lot of forward-thinking politicians in Colorado now who might be approachable in really overhauling securities law within the state. So really, I would say almost everything on my list is doable in the very near term here. But I would start with the self-directed IRA because that really brings it home to people that they have many more options than they think they do. I think we have time for one more question, if there is one. Well, is there any a closing statement? All right. Well, here the closing statement would be this. We ought to be having this $15 trillion shift. The only reason we're not having it is we have obsolete laws that are about to change. And even if they don't change, there are all kinds of social innovations out there that you can begin immediately that effectively will change all of the context anyway. So I would just challenge you that if you care about community, and every hand went up in the first question I asked tonight, every hand went up to acknowledge that local businesses are the key to local prosperity, that if you really believe that, start taking some steps in shifting your money. You don't have to do a lot. If you do 1% per year of shifting your money from the old kinds of investments to the new kinds of investments, it will make a huge difference. Gandhi once said, everything you do is insignificant, and yet it is very important that you do it. Thank you very much. I want to begin by asking some questions, and since my friend David Barsamian is recording this, I will say what I see. And so by a show of hands here, how many people think that local businesses are pretty key to the prosperity of your community? Okay, everyone has raised their hands, and let it be said we are here in the great independent Boulder Bookstore, which is a model of a reason why we embrace local businesses. So the second question I want to ask is, how many of you do your banking at a local bank or a credit union? Now again, almost all the hands went up. There are a few exceptions. We'll take them out and have a chat with them later. The final question is, those of you with pension funds, how many have your pension funds largely invested in local business? Now, I duly report that not a single hand went up in the air. And this is perverse. It's perverse because half of our economy, half of the Boulder economy, half of the Colorado economy, half of the US economy is local small business. And yet, we Americans, when it comes to long-term investments, stocks, bonds, mutual funds, pension funds, insurance funds, we are 100% invested in either local economy. So this is a transition that could actually move very quickly. What I want to do tonight is share with you 10 optimistic trends that I identify in the book, Local Dollars, Local Sense. It's worth saying that the first time that I spoke on local economy issues was at the University of Kentucky 15 years ago, and 2 people showed up, 1 left early. So I feel like the movement has come a long way since then. And I will run through each of these trends and provide a little bit of elaboration, and then we'll have some time for questions around each of these trends afterwards. So the first trend I want to flag is that there is a massive decline in Wall Street's credibility. This is great news because Americans have, for the last 25 years, automatically fed their retirement monies into Wall Street. There are 7,500 mutual funds in the United States, and not a single one puts money in local small business. We have artificially propped up the value, the power, and the influence of large global companies. I must say it has been very heartening over the past year as I've been finishing this book to see the growth of the Occupy Wall Street movement. And now even Newt Gingrich and Rick Perry attack Mitt Romney for vulture capitalism. And I think many Republicans really are concerned about this. So across the political spectrum, there is deep skepticism on Wall Street. And there should be, because the performance of Wall Street has been abysmal. I begin the book by performing an exercise with data from a Yale professor, Robert Shiller, who wrote a book called Irrational Exuberance. And on his website, he has historical prices of stocks going back to the founding of the stock markets 140 years ago. And what you find is that even though you have all of these investment advisors out there like Rick Edelman on AM radio telling you, put your money in stocks long term, you'll get 8%, 10%, 12%, 20%. In point of fact, all of these claims are made in inflated dollars. When you take inflation out, account for dividends, and don't automatically reinvest each year to just see what the annual rate of return is and how it would compare with other annual rates of return, the stock market has performed on average at 2.6% for 140 years. Now, if you're clever at moving your money in and out of the stock market at the right times, you can pick that up. So I assume that the goal to beat, that for local investment to beat, is not 2.6%, but a more robust 5%. And we'll come back to that number in a moment. If you were a perfect investor today for government bonds or Fortune 500 companies, there is not a whit of local investment in the $30 trillion that we have invested long term. This is a huge capital market failure. And what I would argue is that all of us, especially those of us who are gathered in this audience who embrace local economies, we are systematically over-investing in Fortune 500 companies and under-investing, or that is totally neglecting, local small business. I think the reasons why this is happening are interesting and can be fixed, but let me just make one initial observation, that if capital markets were working, there would be a $15 trillion shift from Wall Street to Main Street. What would $15 trillion look like? Well, what $15 trillion looks like is $50,000 for every American man, woman, and child. For a 5,000-person town, $50,000 of extra investment would be $250 million more for that town to play with. For Boulder County, with 300,000 people, it would mean $15 billion more of capital for businesses like Boulder Bookstore, where we are tonight. I would suggest that with $15 billion more, the Boulder economy would prosper and grow dramatically. As Michael Brownlee, in introducing me, pointed out, we just did a study of local food here and saw that a 25% shift to food localization could be done for $100 million. A tiny fraction of that $15 billion could really make a huge difference in localizing food and creating almost 2,000 new jobs in this economy, or basically fixing about 1/7 of the unemployment problem here. And besides just the economic effects, let it also be said that local food contributes quite a bit to dealing with obesity and in type 2 diabetes. It is good for bringing down the carbon footprint. Because you bring more taxes into the government, it's good for the fiscal health. So there's many, many valuable things that happen with food localization. But I want to focus more broadly on the importance of localizing the economy holistically. If a $15 trillion shift happened from Wall Street to Main Street, it would be the most dramatic shift of money in U.S. history. I mean, and think of what happens when the first $1 trillion moves out of the stock market. When $1 trillion moves out of the stock market, the prices of stocks drop because there's less demand. And that means that many people who were on the edge of leaving the stock market will leave. And more people will put more money into the